Welcome to the Deep Dive. We're your go-to for breaking down the big earnings calls, really cutting through the noise. Today, we're diving into Dave & Buster's Entertainment, that's ticker PlayY. We're looking at their Q2 FY 2026 earnings, reported September 15th after the bell. Our mission here is simple. Give you the key takeaways from their investor call, distill what matters, and figure out, what actually happened and what might be next.
Yeah, and this call definitely made some waves, maybe more like a thud, really, in the market. The numbers caused a pretty noticeable reaction from investors. So we're going to unpack the financials, look at management's honesty about past mistakes, which was quite something, and their plan to turn things around.
Right. It's a story of, okay, we messed up. Here's how we fix it.
Exactly. Acknowledge challenges, ambitious recovery plan.
Okay, let's get right to it then. The headline numbers for Q2 fiscal 26. Bottom line, they missed expectations pretty significantly on key stuff. GAAP EPS, that's your standard accounting earnings per share, just 33 cents. Adjusted EPS, which, smooths out some items, a little better at 40 cents, but the consensus was looking for 92 cents.
Whoa. Yeah, that's a huge miss, almost half, a little less than half, actually. Even adjusted, it shows the core profit engine just wasn't performing like the market thought it would.
And revenue?
Revenue came in at $557.4 million. Just a hair under the $562.7 million estimate. So basically flat compared to last year.
Flat revenue, okay.
Sure.
But what about comparable store sales, that SSS number everyone watches?
Yeah, that's the one that really hurts, I think. Comparable store sales decreased by 3.0% year over year. For a concept like this, seeing sales drop in stores open at least a year, that's a big warning sign. It tells you the core business is struggling to attract or keep customer spending.
Definitely a red flag. And profitability took a hit too, right? Adjusted EBITDA.
It did. Adjusted EBITDA was $129.8 million. And look at the operating margin slipped to 9.5% last year. It was 15.2%.
Ouch. That's a serious squeeze on margins. These aren't just small misses, are they?
No, not at all. They point to some pretty fundamental issues. Now, to be fair, operating cash flow was still positive, about $34 million. And they ended the quarter with solid liquidity, around $443 million. So they aren't out of cash. But yeah, the misses on EPS, revenue, and especially those comps and margins, it paints a picture of a really tough quarter.
Okay, so let's unpack why. There's a big change at the top, right? New CEO.
That's right. Tarun Lal. He joined in July.
Yeah.
Comes with over 30 years of experience, a lot of it at Yum. Brands think KFC, Taco Bell, Pizza Hut, global experience there. And what was striking on the call was how candid he was. Very direct about the business's problems.
Refreshing, sometimes. So what did he say went wrong? What did the new management identify as the missteps?
Well, they didn't hold back. They basically said previous strategies had kind of dulled the core appeal of Dave & Buster's, led to execution failures. They broke it down pretty clearly.
Okay, give us the breakdown of what wasn't working.
All right. First, marketing. They'd completely gotten rid of TV ads, which for a brand like D&B seems like a big move. And the promotions. Too many, unfocused, apparently went from a few targeted offers to like 20 different things.
Yeah.
Confusing.
Yeah. Hard to keep track. What about food and drinks?
Food and beverage. They leaned too hard on appetizers, shareable stuff, and actually cut some popular higher revenue entrees. So less incentive for a full meal, maybe.
Okay. And operations, the actual running of the stores.
That was another big one. Right. Operations. They admitted they moved too fast on initiatives, caused disruption. Communication broke down between corporate and the stores. And crucially, training focus was lost. You can imagine the impact on the guest experience when staff aren't trained well or initiatives are messy.
Mm-hmm. Frontline impact. And the games, that's kind of their main draw, isn't it?
You think so. But games, a huge cut in new game introductions, down almost 80%. Plus, the pricing structures got too complicated. If the games aren't new and exciting and it's confusing to pay for them, why go?
Wow, 80% cut in new games. That's staggering for an arcade concept. Anything else?
Yeah, a couple more big ones. Remodels. They spend a lot on a new store prototype that didn't perform well. They didn't even market it properly. Yeah. Bad combo. And finally, just overall CapEx discipline. Poor capital spending habits, which hurt cash flow. So money wasn't being spent wisely, basically.
That's quite a list. It paints a picture of a company that maybe lost its way, lost focus on the core guest experience.
I think that's exactly what the new CEO is saying, yeah. They acknowledged these weren't external problems, they were internal executional failures.
Okay, acknowledging problems is step one, but fixing them across so many areas at once sounds challenging. What's the plan? What are they actually doing now?
Right, the fix-it list. It's pretty comprehensive. Let's go through it. Marketing. TV ads are coming back. Sharper promotions, fewer, but more impactful. They're launching season passes for fall and winter, plus football watch deals, trying to build frequency.
Makes sense. Get people in the door consistently. Food and beverage, bringing back entrees.
Exactly. Food and beverage, focusing on the eat and play combo to boost how often people buy both. Stronger push on entrees, and yes, a whole revamped menu is launching nationwide in October. Bringing back some favorites, apparently.
Good. What about fixing the operational myths?
Operations, simplifying things, rebuilding that communication link between corporate and the stores, strengthening training, back to basics, really.
Yeah.
Make it easier for staff to deliver.
And the games. The 80% cut reversal.
Big reversal there. Games. They've already rushed in 10 new titles this fiscal year, and they're committing to at least 10 new marketable games every year. Think exclusives, games based on popular IP, stuff people recognize and want to play. And simplified pricing, too. Make it easier to understand the value.
That sounds much more like the D&B people expect. What about those expensive, underperforming remodels?
Remodels. Scrapping that old prototype. Developing a new one that they say will deliver better results at a lower cost. And crucially, with better marketing support this time. Smarter spending.
And the cash flow discipline.
Cash flow. Pursuing capital-light financing for new stores. Like that $77 million sale-leaseback deal they did. Yeah. Basically selling the property and leasing it back. Frees up cash for growth without heavy upfront investment. And cutting wasteful spending elsewhere.
Okay, so it sounds like a very clear, point-by-point plan to address those specific failures. But how does this translate financially, especially after that rough Q2?
That's the million-dollar question, isn't it? While Q2 was rough, management stressed the underlying financial position is still decent. We mentioned the positive operating cash flow, the liquidity. That $77 million sale-leaseback helps a lot, too. It gives them funding for new stores without tipping too much into existing cash.
So they're still growing, still opening new locations even while fixing the core.
They are. Opened 3 new D&Bs in Q2, aiming for 11 total this fiscal year. Plus international expansion, 5 more coming soon, deals for 35 plus more after that. Management framed this 6-7% unit growth as energizing, not a distraction. Lal, the CEO, was clear. Focus on guest-first culture, memorable experiences, and driving growth in sales, cash flow, shareholder value. He even said he thinks the stock is extremely undervalued.
A new CEO saying the stock's undervalued. Classic. But okay, clear plan, some financial stability.
Yeah.
But the market reaction was brutal, wasn't it?
Oh, yeah. Brutal is a good word. After the call, the stock dropped, what was it, about 16.7% the next day. Trading volume went nuts, like nearly 6.5 million shares traded versus a normal day under a million. Clearly, the market was spooked by the misses.
And how did that compare to the rest of the industry? Were other restaurants struggling too?
That's what makes it stark. D&B's negative 3% comparable sales was way worse than the overall restaurant sector, which actually grew comps by about 1.3% in Q2. Casual dining, their closer peer group, did even better at plus 4.4%. So D&B was really lagging. It underscores that these were company-specific issues, not just industry headwinds.
So you have this divergence management saying, we have a plan, trust us, it's undervalued, and the market saying, show me the results first, these numbers are bad.
Precisely. Management's focused on the long-term fix, the back-to-basics turnaround. The market's reacting to the immediate pain, the sales erosion, the margin pressure. Analysts see the potential, maybe, but that near-term pressure is undeniable. Investors want proof.
What about that CEO confidence? You mentioned he feels it's undervalued. Did he put any skin in the game?
He did, actually, and this is important. He mentioned his own compensation is now tied to hitting a specific new EBITDA target, $675 million annually. That's a concrete goal. It replaces some vague billion-dollar target that was floating around before, which he said he wasn't even sure at the timeline for. This $675 million target feels more grounded, though still ambitious, and aligns him directly with delivering results.
Okay, a target to watch. So for listeners trying to gauge if this turnaround is working, what are the key things to look for in the next, say, 1 or 2 quarters?
All right, the catalysts. First, you need to see that comparable store sales number improve. That negative 3% has to start climbing. Ideally, get back to positive. That's job one. Second, look for signs the food strategy is working. Better attach rates, more people buying food with games, higher average checks. Is the new menu landing? Third, evidence the game refresh is boosting play. Are people staying longer, spending more on games? And any updates to full-year guidance from management will be key. Do they sound more confident? They did acknowledge the macro environment, consumers wanting value. So watching how their simplified message and unique games perform against that backdrop is important too.
Makes sense. It's really about execution now. Can they deliver on this plan?
It's the whole story.
Okay, we've laid out the problems, the plan, the market's reaction. Now, for a bit of fun, our This Is Not Financial Advice segment, we brainstorm an outrageous but maybe just plausible trade idea based on all this.
All right. Given that huge stock drop after earnings, the clear turnaround plan from a new, experienced CEO, and the fact they still have a decent balance sheet, here's a thought.
Lay it on us.
It's the bounce back with Lal leap call play. The idea: consider buying long-dated, out-of-the-money call options. Think calls expiring maybe mid-2026 or even later. And set the strike prices, say 20% to 30% above where the stock is trading right now after the drop.
Okay, break that down. Long-dated, out-of-the-money calls. What's the simple version?
Sure, a call option gives you the right, not the obligation, to buy a stock at a set price, the strike price, before a certain date. Out of the money means that strike price is higher than the current stock price. So you need the stock to go up quite a bit just to break even. Long dated or leap just means the expiration date is far away, 18 months, 2 years, maybe more. It gives the turnaround story time to actually happen. So you're basically making a leveraged bet that the stock will significantly recover over the next year or two.
Got it. A leverage bet on the turnaround. What makes this specific idea outrageous, and what makes it plausible?
Well, the outrageous part is you're betting on a pretty significant turnaround to happen relatively quickly, enough to overcome those bad Q2 numbers and the market's current skepticism. It requires real execution. The plausible part: you've got an experienced CEO, Tarun Lal, who seems to have correctly diagnosed the problems, and they seem like fixable execution issues, not fundamental business model flaws. The company has the liquidity to fund the changes, and Lal himself said the stock is materially undervalued. If he starts delivering on that $675 million EBITDA target, the stock could certainly bounce back significantly from these lows. The options give you leverage on that potential upside. If it works, the payoff could be much larger than just buying the stock. But if it doesn't, options can expire worthless. High risk, potential high reward.
A classic turnaround bet, amplified with options, definitely fits the outrageous but plausible bill. Okay, let's wrap this up. To recap, Dave & Buster's Q2 fiscal 26. A big miss across the board. EPS, revenue, comps, margins, all disappointed, leading to that sharp stock sell-off.
Yeah, tough quarter. But the key takeaway from the call wasn't just the bad numbers. It was the candor from the new CEO, Tarun Lal. He laid out a very detailed assessment of why they missed the marketing mistakes, the operational issues, the neglect of games, and a concrete plan to fix it. Focus on the core, innovate games, run the business better, manage cash wisely.
So the market's watching closely now. Can they execute? Will we see comps and margins start to improve in the coming quarters? That's the big question.
Exactly. It's a show me story now. Leadership's under the microscope.
So as you think about all this, here's a final thought. In a world where people are definitely looking for unique entertainment and social experiences, can Dave & Buster's, with this new leadership and a renewed focus, actually recapture that magic? Can they become that go-to eat, play, watch destination again? Could today's problems really become tomorrow's success story? Something to chew on. And remember, everything we've discussed here is for educational purposes. It is absolutely not financial advice. Always do your own homework, your own due diligence before making any investment decisions. Thanks for joining us on The Deep Dive. We'll be back soon with more insights from the world of earnings calls.